We're going to do chapter 6, maybe some of chapter 7, maybe a little of chapter 7 tonight. The initial part of the audit, okay? That's what this is, of course. Let's talk about the first thing. Let's talk about getting clients, which is, how does the process work? How does this process actually happen? And what are our responsibilities as an accounting firm? I mean, it's not a simple matter of, somebody calls on the phone and says, hey, Cohen Resnick, I want to hire you as accountants. We go, yes, and the deal's over, okay? In fact, I've actually had that happen where we've had prospective clients call, say, I've heard good things. One of my friends is one of your clients. I'd like to hire you guys. And I go, that's not the way the process is. As much as you're hiring us, we're taking you on as a client. So what happens is, when prospective clients call, normally the process is that they call several accounting firms. Most times they will interview several. When you're lucky, you're the only one at the dance. You hope for that. It always depends on where the referrals come from. When they come from other clients, those are usually your best referrals. A happy customer tells somebody else, you have a much better chance of getting the account than when they come from, just word of mouth, or they see ads, and they see your name and go, I want a mid-size, I want a national accounting firm, and there's several of them, but they put your name on the list. Well, what happens is you go out, you interview the prospective client, and then you submit a proposal. I mean, that's the normal process. You're going to go through, you're going to go out, you're going to meet the client, you're going to gather information, you're going to take your best guess at what the fee is going to be, what the client's looking for, and you submit a proposal to them, usually through, whoever it is. If it's a public company, it's going to be through the audit committee. If it's a private company, it's going to be through whoever. And then hopefully at the end of the day, you get the account, that you make arrangements, that you get the client, statistics on those types of things. You probably get the answer statistically what percentage of clients you get that you go out to propose on. It's probably somewhere between 30 and 40% of the time you go out. I use that statistic in my head when I was running the part of the firm, because on most proposals there's at least 3 accounting firms that go out. And I figured if we got our fair share, our competition's good, we're good, you're going to get your fair share of clients. Somewhere in the 30 to 40% range, you were doing okay. Well, let's say you get the client. What do you do? I mean, you don't turn around and start the audit the next day. It's okay, you've made some type of arrangement, the client's accepted your fee. What happens? Well, your first requirement, and this is a requirement under GAAS in the literature, is that you need to communicate with the predecessor auditor. It's never a comfortable conversation, I will be honest with you. Well, sometimes it's okay. And there's times that the predecessor auditor has resigned, maybe he's retiring, maybe the predecessor auditor is giving up the account because they know that the account's too big for them, too complicated. That happens oftentimes. A lot of the clients that a firm gets are because they're sort of coming up the food chain, they've outgrown their prior accountant, and maybe their lending institution or their investor has said, hey, you need a bigger, more prestigious, more well-known accounting firm, one that I know more about. And while small firms may be very quality, there's a belief in this industry that bigger is better. Just like we get clients from smaller accounting firms, we sometimes lose them to the big four in instances where the investor or the bank is requiring, it has to be one of those 4 accounting firms. But when you call the prior auditor, what do you say other than, sort of just like, hey, I got the account? There's a required list of things you have to ask them before you're allowed to accept the account, and you have to document this in your work papers. Remember, this is all about documentation all the time when we do work. One, you have to question the integrity of management. Hey, did you find them to be honest people? It's one of the fears that a client has if they're not. we did have an instance a number of years ago where we found a client had lied to us about something. It wasn't a major item, but we did find that we found a discrepancy between something they said and what we found out. And it was a matter of something they didn't want to tell us because they were embarrassed about it. And the managing partner of the firm went down and said, listen, if you ever do that again, two things are going to happen. One, we're going to resign, and two, when the next accounting firm calls up and asks why we resigned, we can say because it was integrity. You lied to us. Never happened again. They apologized. They said it wasn't a major item, but it was concerning when somebody tells you something that's not true. You always have to ask if there's any disagreements over accounting principles. That's often something that people will change accountants for. They don't like the way you're doing things. You argued with them about rules. Now, they could have been right, and you could have been wrong. That's a possibility. But you assume most times accountants know what they're doing. So people do what's called opinion shopping. Hey, listen, I don't like the way they're interpreting that rule. Let me see if I can find another accountant. Maybe he's not going to see it or he's not going to disagree with it. So you have to ask about that. Do you have any disagreements about accounting principles? You have to ask about anything regarding fraud and non-compliance with laws. You have to talk about you have to find out if there are any communications concerning internal control, significant deficiencies and weaknesses. You have to write a letter to the audit committee. And you also, in the case of public companies in particular, private companies not so much, public companies, you have to ask the predecessor auditor if they know why they were dismissed. Because that is something that the SEC requires in a filing called an 8K. When a public company changes auditors, they have a very limited period of time to inform the SEC that they're changing accountants and the reason why. And the reason the SEC wants to know is, hey, was it over things like this? Was it an integrity issue? Was it a disagreement about accounting principles? And not only does the company got to file this document, but the accounting firm has to read it. The accounting firm has to read it. So if there was a disagreement over accounting principles, and they don't want to tell the SEC, the accountant has the right to tell the SEC, and that wasn't the problem. We told them what their revenue recognition policies were incorrect, and they didn't like that, so they fired us. So the SEC's on top of stuff like that. You don't need to do that in the case of a private company. You don't have to ask the guy, the prior accountant, you know why you were fired. So again, we're looking for integrity, we're looking for issues, and it's a requirement. You don't have to do it in writing, and it's sometimes a difficult procedure. Because sometimes when accountants get terminated, they're not happy. So being cooperative isn't the first thought. You find out in the middle of tax season you just lost a client, it's not your first priority to see how to service this ex-client. You've got other things to do. So there are times, like I said, it can be a difficult process trying to talk to the predecessor accountants. What are the steps in the audit process itself? Now that you've got the account, okay? There are 6 steps to an audit process. The first is generally you're planning the engagement. The second is you're now going into the account and you're getting an understanding. This is critical. Getting an understanding of the client and its environment, including internal controls. This is key to the audit, to figuring out the steps you're going to take in order to eliminate as much risk as you can. But again, it's the understanding of the client that's key. Clients hire accountants who understand their business. They want to be able to talk to you about their business. They want you to understand the accounting for their business, the particulars to their business. They don't assume today, in this day and age anymore, that accountants are the generalists in accounting work. You're going into the accounting industry, going into public accounting, within a short period of time, somebody's probably going to ask you to specialize in something. Some type of industry specialization. We have a zillion and one different ones. We're looking for people who become experts. That's why people hire accountants, because they're experts in what they do. So understanding clients is key to understanding how to do an audit. And you don't understand the client until you understand their business. Once you understand the business and you understand the environment, the control environment, is when you do what's called your risk assessments. And auditing today is all about, you read it, you saw the word, I don't know how many times when you stay up that night reading the book, you see the word risk. What was it in every single sentence? Risk, right? It's all about risk. That's what we're doing today, risk-based auditing. We sit back, we look for where the risks are, that things could go wrong, and that's where we attack. Okay? So we assess the risks of material misstatement. We've now looked at their control environment, we figured out what kind of business they're in, how they do their accounting records, what kind of people are taking care of their accounting records. We sit down and we design our audit procedures around that. Once we start doing the audit, we add on further audit procedures as we go, as we walk through and we start doing things, we see whether, hey, well, how are the results coming out? Did the sampling come out okay? Did the numbers come out okay? Are we making a lot of adjustments? Are we finding things wrong? Are we finding holes in the system that cause you to do more audit procedures? Eventually, you do what's all the completion steps in an audit, final analytical, final questioning, all the stuff you do at the end, final legal confirmations. And the last step, of course, is forming an opinion and issuing the audit report. This chapter, like I said, is the starting point, okay? When we start talking about audit procedures, it'll be from chapter sort of 10 on, when we go into particular accounts and how we audit them, how we audit cash, how we audit receivables, what are the steps that are necessary. Talk about planning. This is the first step. It's got to be documented like everything does. It always starts with the plan. Everybody's got to be involved in it. What goes into planning an audit, okay? You start every audit with what's called an engagement letter. When I started in accounting, an engagement letter was about 2 pages. Today, it's about the size of a short novel. I'm serious. It's about this big. The book said something, because I did read it, that said if you've got an engagement that's sort of routine year in, year out, and the engagement is not changing year to year, that you could leave, like, you had an engagement letter from last year, you could keep the engagement letter. You could use it. That's actually, we don't do that anymore. And I don't think any firm does. Every firm would require an engagement letter every year. And in fact, we use negative engagement letters in our firm today, and I think most firms do, for almost everything we do. We even send engagement letters out on tax returns now because of liability issues. We tell clients what we do, what we don't do, what we're responsible for, what they're responsible for, and put it in writing. And the tax returns, because there's so many thousands of them, we do it in what's called a negative form. We say, here's the engagement, unless you have a problem that something here is wrong, we'll assume that the letter is in accordance with the agreement. And we're going to see how that works in confirmation process later on when we get to doing when we talk about confirming with outside people, what's called positive and negative confirmations. So we start with an engagement letter. What are the important things? One, we want to make sure, of course, related to that we meet independence requirements. Can't do an audit if you're not independent, so we make sure of that, okay? We find out there's no management integrity issues. We're always going to start with that. And then the important thing is that the client understands the terms of the engagement. So what items are included in the letter? Of course, the name of the entity. That's ridiculous, okay? We always tell management, here's what you're responsible for, okay? We don't want any confusion. This is what you do. This is what we do. Let's agree on that. So we tell them the financial statements, they're yours. Don't get any confusion about this. Now today, especially in the public world, people understand that the financial statements belong to the client. That's not always been the case. I had a client a long time ago, older gentleman, very successful business. We came in, he give us the books and records, we audit them, we do the financial statements. It was a private company. And he couldn't understand the concept that they were his numbers. He said, you did them, you put them on paper, they belong to you. You have these violent fights every year over this. Why do I got to take responsibility for this? You're my auditor, you take responsibility. He didn't quite get this concept, okay? Shall we say management? You're responsible for financials. You're responsible for effective internal control. You're responsible for compliance with laws. Not our responsibility for you to be compliant, it's yours. You're responsible for making records available to the auditors. It's your job to get us the records, okay? And you're responsible at the end of the audit for representations, okay? And that's going to be called our management representation letter at the end. So we tell them what they're responsible for. We then tell them what we're responsible for. This is what we're going to do. We're going to conduct an audit in accordance with GAS. We're going to get an understanding of your internal control, and we're going to make all the communications required by GAS. In other words, these are your records. They're your responsibility. We're coming in and doing the audit. What other things are in there? Well, you might say, well, that didn't sound like 35 pages. Well, today we put in there all the legal responsibilities. We put in there always something about, what if we can't finish the audit? What if we get halfway through? Are we legally responsible to finish an audit that we started? Does anybody think we are? Anybody want to volunteer? Do you think we have to finish an audit? No, we don't. Assuming it's their fault. Assuming it's their fault, okay? If we can't get the records that we need, we can't do the documentation that we need, they're uncooperative with the terms of the letter. Say there's a fee arrangement in this letter. We oftentimes in that letter put in a fee arrangement, fees and bills. We always put in the letter something in effect, okay, here's how much we're charging you, and this is when you're responsible for paying the bills. In the event you don't pay our bills on time, we have the right to stop the job. So we say, okay, you're going to pay us $25,000 a month starting on the 1st of every month as we do this job, and we get in there on the 1st, we start doing the work, and 10 days later we haven't been paid. It'll probably spell out in the letter that we have the right to stop the job. Okay? We also always put in these letters, what happens if we find what if we have a fee issue? What happens? You have a fee arrangement with the client. We're going to charge you X for doing the audit. Provided you do all the things you said you were going to do. And you could put in here conduct of the audit, timing, client assistance. There's a perfect example. Hey, Cohen resident, I don't want this audit to cost too much. That's fine. You want it to cost less money, you have to be ready on February 1st, all work papers, all journal entries, everything's ready for us to go. So we get in on February 1, and we can be out on February 10th. Absolutely, I want you out in 2 weeks. I want you gone. I'll have everything ready for you. Great. You'll do that. Here's the fee. However, if you don't comply with this, we have the right to change it or to stop the job. And we get in here on February 1 and said, okay, where's the cash? The receivables aren't up. I didn't get the bank recs done yet. The receivables aren't ready. I'll give you a couple of fixed asset schedules. I got 5 auditors ready to go. Sitting around the table. Well, I only have enough work for 1. Now all of a sudden that 2-week audit is going to take 3 and 4 weeks, okay? Oftentimes you put something in provisions in the engagement letter and say, hey, what's I promise you a fee of X if you comply with these conditions. But hey, wait, the rules change, okay? Rules change. So you put things like that in. You also have to put in there if you're going to use specialists or their internal auditors. Oftentimes, in order to keep fees down, you can use their people to assist you in the job, provided, and we're going to talk about that, you find the qualifications for people. You also have to put in there if you're going to use specialists. Again, we come back to what's a specialist? Again, I'm doing a jewelry inventory. I'm not qualified to value diamonds, and nobody in my firm is qualified to figure out whether a diamond's real or what it's worth. I'm going to have to hire specialists. These are outside people, outside of Cohen and outside the accounting firm. We don't have diamond specialists on our payroll. We've got to go out and hire third parties. You've got to tell the client that you're going to have people coming in to work on their stuff that's not a representative of our firm. They've got to allow that. You've got to get permission. Remember, what we do is confidential. They hire us, but we're not qualified to do certain things. So if we have to go outside there, you got to get their permission, and you do it through the engagement letter. And you sometimes have to get permission to talk to their predecessor auditors. You just want to make sure that you're going to be especially getting information. It's not only talking to them, it's getting the information. In a lot of cases, especially in private companies, a lot of the quote-unquote records are kept by the accountant. Hey, my people don't know how to do depreciation schedules. They don't know how to compute the reserve for bad debts. The accountants did that. I just booked the entries that they gave me. Oh, well, I need the fixed asset schedules. Hey, I talked to my accountant. He has those. How about the deferred tax provision? They look into what? The deferred taxes. Well, I don't know how to do that. Talk to the accountant. So you're going to have to go back to the predecessor auditor to get those work papers, which again can be sometimes a little contentious. Now, of course, if you're going to do anything else, you're going to put an engagement letter. And like I say, today firms are extremely careful with engagement letters. There's a lot of stuff in there, a lot of stuff that clients sometimes say, it sounds like you're really protecting yourself, and that is the purpose. You even put in there how to settle disputes. Yes?
I have a question with the specialist. So you were saying with the diamond?
Yeah.
So what happens like if they're not comfortable with like a third party? Are you able to resign and tell them like, I'm not...
I can't. An inventory is a material number. I would look at it and go, how do I know it's a diamond? Because here's the issue. I say, fine. Cohen resident can't do this. Who are you going to call? You think? PwC doesn't have, I don't think they have people on staff either. Any accounting firm would have to go to somebody who's a certified gemologist, okay? To be able to value those inventories. You have to do this in so many cases. I've had clients again in the precious metals business. Well, I think do I know gold when I say, well, I know it looks like gold. Do I know if it's 14 karat or 24 karat? No. You need somebody to come in and test that. You need it in a lot of businesses to test inventory for what, we talk about TV sets. Yeah, I know a TV set when I say one, okay? I don't need a specialist to tell me whether that's a Sony TV. But if I'm valuing something, some type of chemicals or something, I may need somebody to actually test it and find out, yeah, that's what he said, they said that is. It's a clear liquid. Now, I don't know if it's water, so I may have to send it out for sampling if it's got some type of a value based on what it is, okay? So yeah, you need specialists. You need specialists in valuation all the time. In fact, if you're doing valuation, the one thing you can say is your firm can't do it. You've got an independence issue. We have a valuation group in our firm, I know which one. They can handle any type of a project. But they can't do the valuations on our audits. You're auditing your own stuff, which is illegal. You can't audit your own work. We value it and we audit it. So when you do a valuation, you got a real estate valuation, you got a goodwill valuation. Anytime you got goodwill on a company, you got to go out and get it valued. It's a public company, right? Unless you know it's okay. The company's flourishing, you know the goodwill. But if you've got goodwill and bearing issues, you got to get a goodwill valuation. Well, you got to go to a third party, even if it's an accounting firm. So fine, we'll take the goodwill valuation to PwC. It's still a third party. They've got the firm, the client has to say, oh, it's all right for PwC to be looking at it. Okay? I know that you're going to outsiders. All this gets handled in an engagement letter, and you never start a job without an engagement letter. And like I said, limitations regarding liability of the auditors or the client It's always spelled out in there. There's always in there as much protection as you can get on your own liability. You try to get. You put in. We put in arbitration clauses into there. Hey, if there's a dispute, we want to go to arbitration. We don't want to go to court. There's a lot of stuff that goes into engagement letters in the year 2015. Clients are mesmerized by the size of these things at this point in time. Okay. So now you're at the point, you got the engagement letter, you're at the planning stage, okay? First thing you do is an audit strategy and an audit plan, okay? Remember, we have efficiency issues, we have dollar issues. We always try to plan to use the client's people as much as possible. The client's people can't audit, but they can do an awful lot of work for you. And to the extent that the work can be done by the client, you're saving the client money and you're saving yourself time, especially busy times of the year. So you don't want to prepare the fixed asset schedules. You want the client to give you receivables that tie in. You want the client to prepare the reserve and bad debt schedule. You don't want to have to do original work. You want the client, when you're checking invoices or vouching sales, you want the client staff to pull the work for you. You don't have to go through the file. So you want to use the client's people as much as possible. And you put that into your audit planning and into your engagement letter as well, saying, hey, we're going to be using your people. If you have to use other CPAs, this is part of the planning process. I'll give you an example of using other CPAs even in small accounts. We do it for accountants. Other accountants do it for us. It's perfectly legitimate. We'll have a New Jersey client. Client's based here in Jersey. Everything's in Jersey except this warehouse in Utah. Okay? The warehouse in the middle of nowhere, Utah. Okay? The cost, and then we go, is the inventory material? Yeah. But is it an easy inventory to take? Yeah, it's a 1 day. In, out, count stuff, you're good to go. But it's material enough that needs to be counted as part of the audit process. If you didn't count it, you'd be remiss. So you look at the cost of going to Utah for a day and you go, wait a minute. I can't fly out in the morning and get back at the end of the day. The job's going to take 5 hours to do, okay? But I got to send a staff person the day before. I got to pay for the cost of meals. I got to pay for a plane. I got to pay for a hotel. I got to have a staff account out of town for 2-3 days between going there, getting back, and all. I go, how about this? We know a good firm in Utah. I call somebody out there. I get the clients okay. And they say, we're going to hire an accounting firm in Utah to go count the inventory for us. We do it for other accounting firms. I have a client we do every year. We get about $1,500 to go run a count of quick inventory here that's in New Jersey with a client out of in Texas or something like that. So you can hire another accounting firm as long as you know what the accounting firm is. You got to give them directions of what you want. You don't just say go take inventory. You give them an audit plan. You ask them to fill in the audit plan. You give them a budget. They have to send you their work papers. You got to read them to make sure they did what you said. But you save yourself a whole bunch of money and save the client money for travel and time. So if you're involving other CPAs in your job, and if it's that or they're auditing a subsidiary, it's all part of your audit plan. But it's extremely common. You arrange for your specialist as part of your plan. And again, if it's a first-year audit, and first-year audits are different than audits afterwards, okay? You have to communicate with the predecessor auditors. But in addition, you got to make yourself comfortable with the opening balance sheet. Remember, you've been called upon to audit this year. Say it's 2014. Part of 2014 is the opening balances on January 1 of 2014. You've got to be comfortable that those numbers are okay. Now, some things are easy to establish. Some things you don't need to look at again because they're going to be different when you get them. But what if the major item on your balance sheet is fixed assets? okay? This is the biggest item on your balance sheet. This is a company in real estate. So when you look at their balance sheet, they got a couple bucks in cash, a few dollars in receivables, a couple other assets. But fixed assets, buildings, land, whatever, are your biggest number. When you take over the audit, and you're going to issue your opinion on the financial statements the following year, well, that's going to be the biggest item on your balance sheet. How do you know those numbers are right? The prior accountant did them or audited them. Okay? Do you have to go back and do some re-verification? What you would do is you'd look at their work papers to see what their procedures are. To some degree, you would assess who they are. I hate to say we do that, but we do. There's a whole big difference between taking over the work papers when PricewaterhouseCoopers did the audit before us, my reliance on them, and some accounting firm that I never heard of, okay? That I never heard of. I pick up the opinion, and I look at an opinion that's the opinion we used to use 5 years ago, okay? And I say, we've changed the way the opinion's written. These accountants are not up to date. I pull the work papers. I don't see what kind of audit techniques or audit procedures they used on the fixed asset accounts. They go, wait a minute, these are carry forward balances. I'm responsible for them now. I got to make sure they're right. And sometimes that's not easy. The building could be on the books for 10 years. What am I going to do? Go back and ask for the records for the acquisition 10 years ago? Well, maybe I have to. Sometimes you've got to go back and re-audit. What happens when you pick up a financial statement and you start reading it and you go, wait a minute, these things don't seem right. These numbers, there's accounting problems. I've got to go back and redo some of the opening balances. But if I look at this and go, wait a minute, these capitalization policies are ridiculous, okay? But you're hoping they're okay, but you've got to go back and look at opening balances and make sure you're comfortable with it, because if they're wrong, they're going to reflect themselves either in your ending balances or your profit and loss statement's going to be wrong. Wrong receivables, wrong cash. They start the year with the wrong balance sheet, and you get the right balance sheet at the end of the year, okay? Your balance sheet's fine, but the income statement's got to be screwed up, okay? The difference, okay? So again, opening first-year audits are much more complicated, so you feel comfortable with systems and numbers. But again, it all comes from, to some degree, who you inherited it from. Did you get the comfort level one way or the other? That's not to say that there's not mistakes that big firms make. It's not to say that we haven't made mistakes and people call and say we don't agree with something you did. But your comfort level goes up dramatically based on the size and your knowledge of the firm that was your predecessor. Okay? There's that word again, risk assessment. Okay, this is what we do at this point in time. Okay, we decide how risky and where the risks are. Where can things go wrong? That's the terminology. Where do I have to look? What are the material items? What are the things where there can be really problems? Where is the risk? So how do we do this? Inquiries of management and others within the entity. We sit down and we actually go to management, financial management, operations management, and we ask a lot of questions. Now, the questions you ask, you don't send out an accountant, okay? Now, if you say, well, geez, I'm going to get assigned to an audit, the manager on the account's going to go and say, go talk to the controller. Ask him some questions. You don't have to really worry about that. All firms have standard forms with the standard questions. You're going to go down a checklist, and you're going to ask some very standardized questions, okay? About integrity, about controls. So you're going to go out and you're going to ask questions of management. You're going to do certain analytical procedures. You're going to look at the numbers. You're going to analyze them and say, do they make sense? Where's my risk in the numbers, okay? I'll give you a very easy example. We have a client. Say you got two companies, about the same size. We're going to talk about the account receivable balance, okay? I have a client that at the end of the year, I don't want to say that I think currently could by the end of the year have $1 billion in AR, okay? But it's made up of thousands and thousands of small dollar balances, okay? It says the risk in this is not too particularly high when we look at it. You say, because of the size of the accounts, okay, for this thing to be dramatically screwed up or overstated, you've got to go through and adjust a lot of accounts. I mean, we're talking about $500, $1,000, $10,000, $20,000 accounts. The risk on this is a heck of a lot different than if that $1 billion is made up of 5 accounts, okay? Where one major transaction could really get you. You understand the difference? This is zillions of little transactions. So we sort of look at that and go, we don't see as much risk in that as we would if it was made up of a lot of large balances. When we audit this, we look for aging, how old are the accounts, has there been a traumatic change in the aging? Is it analytically the aging makes sense based on the business that we know and the economy? But we don't see, although it's the largest item on the balance sheet by far, we've never found that item to be a particular risk because of the size of the accounts in it. So it's an analytical procedure. Observation and inspection related to client activities, operations, documents. You're going to look and see how they're running their business. They run a neat business, but believe it or not, you look around. What do the offices look like? When offices look like papers all over the place, normally the record keeping follows suit. You walk into a client and everything seems neat, the operations are clean and smooth. You get the impression again from observation, inspection, that your risk isn't as high. Inquiries of outsiders, legal counsel, valuation experts, and anything you can read. There's no limitations on what you're allowed to do in assessing your risk. Read journals about the industry. Google the company. Do whatever you want. Read articles about it. Follow their stock if they're a public company. Go to rating organizations. Pull up their credit ratings. Anything you want to do that helps you assess the risk and understand the client and its environment. Again, this is all about I find auditing to be, there's a lot of rules. But I've always found that auditing is a common sense business, okay? Like I said often, it's using your eyes, your ears, and your nose, okay? When things don't look right or smell right, that's when they're usually not. So it's really I think there's a lot of common sense to auditing. Yes, you're going to have forms and checklists and things like that. But a good auditor uses, again, skepticism, as we said, balance. And when I say balance, you have to understand the clients hire us. Being skeptical is one thing. One thing you're not to a client is you're not antagonistic or, I don't think controversial is the word. Confrontation is the word. Every once in a while you'll meet an auditor who thinks they're in there to catch clients. That's not our goal. We're avoiding risk. We're trying to opine on financial statements. Yes, we're looking to make sure there's no material misstatements because that's our job. But we're not in there to be confrontational with our clients, and we're not in there to catch them. That's not what this is about. So how do you understand the client's business? I can't emphasize this enough, the importance, not only as an auditor, but in terms of your ability to deal with a client, in terms of understanding their business. I told you before, and I'm going to repeat this. You want to lose a client? When an accounting firm wants to lose a client, what they do is there's several ways to lose a client. One, do a bait and switch on the audit fee. This happens. All of a sudden, yeah, I told you 50, but we ran well over, it's 100. Clients don't want that. Up the audit fees remark tremendously. They don't like that particularly. But I think more than money, they hate change. I've said this before, I said the same thing. They hate change. They want their accountants to understand them and their business. They want you to come in, know their business, be able to do your audit and leave, with causing the least amount of commotion. They don't want to answer the same questions year in, year out. How do you run your business? I told you that last year. Well, I wasn't on the audit last year. Well, neither were any of the other 5 people on this job. You want to lose a client? Change your records, okay? I'm sending you 5 new this year. I'm going to give you 5 new people the year after, and they're going to tell you the year after you're not their accountants anymore. So you have to understand the client, the nature of the client, their competitor, where do they stand in competition, where are they in their industry, understand their organizational structure. I've had some clients with very simple organizational structures and some that are very, very complex. You need to understand it. You need to understand why it is the way it is. Why are they structured the way they are? It gives you also an understanding that a client in New York, one of our biggest accounts, it was structured totally as a tax, not tax avoidance, tax minimization. They wanted to keep taxes down. They structured everything in a way so it was an extremely complex organization. And if you look at it on the surface, you know, why is it this complex? They're in 3 or 4 businesses. They have 500 different companies, cross-owned, owned this way, owned that way, minority interest. Why? Well, it's to do their best to legally minimize their tax structure. But of course, it causes audit anxiety because there were so many companies in such a complex structure. Understand, of course, there are accounting policies and procedures. That's a given to do an audit. Always know who the ownership is. Who owns the business? One of the problems we had, I told you about that client that you up in the Caribbean, a lot of jewelry stores. They could not, during our audit, verify who owned the company. They told us who did. We couldn't verify. There was no records. We couldn't, you know, yeah. There were no stock records. There was no documentation of ownership. I mean, you can't make it up sometimes. The company's been around a long time. I don't even remember, they'd never been audited before. Whatever records, real records of ownership had been lost or whatever. So when we said, okay, what's the stock? They tell us, okay, we need verification. It's part of an audit. Documented, we have no documentation. How do you verify it? You couldn't. So you need to know who owns it. Yes.
Professor, can I ask him what country was this?
It was in a, why? Are you concerned? You own a jewelry store? You have an interest in what?
No, I'm from the Dominican Republic.
I don't
in the
know.
Caribbean. So.
You see, it's well, the Dominican Republic's attached to Haiti, and that is in the Caribbean. I think it was in a lot of countries. They had like 100 stores throughout the. They had a lot of stores throughout the. But the point being, we couldn't verify ownership. Now that's scary. You gotta know. Never forget one thing. This is who the client is. This is something we teach our accountants all the time. You go in and you work with a client, you work with the controller, you work with the assistant controller, you work on some massive audit, and you work with the accounts payable people and the receivable people. That's your client, yours. We never try to tell our auditors, never lose sight who really you work for. You work for the people in the business. That's who effectively is hiring you. Well, it's hard to do that when you don't know who really owns it. You can't document that, okay? So that's important. Capital structure, of course, important. Product and service lines, of course, you gotta know what they do, what different things they do, what products, understanding the product, where does the product fit in the marketplace, high-priced products, low-priced products, who their competition is, all lead you to understanding the business and lead you on how to audit them properly. Critical business processes, what does that mean? Most businesses, if they're in whatever business they're in, or sometimes when you say critical business processes, some of them are very dependent on the buy side, some of them are more dependent on the sell side, okay? Buying what they get is easy, so on the selling, some companies it's the selling part is sort of locked in, that's easy, it's how well I can buy my product. I say if you talked about the supermarket business, I think the sell side sort of is given. They're very concentrated on, to me, on how they can buy all their things at the cheapest price. That's how they make their money. They make their money on the buy side, okay? It's how well I buy that determines how well I do, not how well I sell. And of course, the internal controls, and we're going to talk about that in the next chapters, internal control. Okay? Competitive environment, supplier and customer relationships. This is extremely important. Some people on the supply side have very limited suppliers. I had a company, interesting company. When I tell you what they do, you'd say, I've never heard of this. Very successful company right here in New York, down by the river. They were one of the world's leaders in using the oil of the shell of the cashew nut. Cashew nut shell, you can't make up that this is really business, but it is, it's a big one. The cashew nut shell secretes an oil that we can't synthesize. We haven't figured out a way yet to make it synthetic. It has certain properties that make it extremely important in two products. Brake linings for your car and marine-based paints. Marine-based paint. Paints that go into ships. That's what they do. They get barrels of this stuff, okay? They get huge drums of this oil. But what's the key? Is being able to buy this stuff, and the cashew nuts are growing in the areas in the world where they grow. I recall Vietnam and India and somewhere in South America. I forget where the other places. There's only a few places in the world but it's on the buy side. It's important that he can buy this product, which I don't think anybody here has ever gone out and tried to buy the oil of a cashew nut shell, because you've never even seen a cashew nut other than in a can or in a jar. It's not one of those things like a peanut you buy with shell on, right? You've never seen a cashew nut in the shell. It's like you've never seen a macadamia nut in the shell, but you've seen peanuts in the shell, of course, right? So anyway, it's a really unusual product, but it's key that he can buy this stuff, okay? So supplier and customer relationships. In this case, supplier relationships are extremely important. What about the companies who are big companies that have very limited customers, okay? I go back to an instance. I had a client that was in the swimming pool business. They manufactured swimming pools and sold it to about 6 or 7 distributors. One distributor was half their business. Came to their annual meeting one year and said, I just want to start the meeting off with bad news. I'm not buying my swimming pools anymore. Company closed and said, they lost 50% of their volume. I'll give you a perfect example of this. We had a company that was the exclusive Budweiser distributor in the New York area. Budweiser gave a call one day and said, we have bad news. You're not our distributor anymore. Guess how long that company took to fold? What? Till the phone got hung up? That was their business. They were a Budweiser distributor. Now they weren't. Is their customer relationship something as an auditor you better be aware of? That, hey, we may have an issue there. They got really, one supplier. Hey, listen, all liquor stores are going to continue selling Bud. They're just going to buy it from somebody else now because you don't have it. And it's not like you lost some local microbrewery. You lost Bud. So, supplier and customer relationships all comes from understanding your client. Technology developments, obviously. Major laws and regulations. Economic conditions. I'll give you one. Again, coming out of my history. Whether you find them interesting or not, I don't know, but there are things you'd be aware of. I had a client that was in the secondary automotive parts business. Their customer base was garages. You took your car to a local garage, you needed to get it fixed, okay? That's who he sold to. Why did that company go out of business? Can anybody want to give me some ideas? What changed in the economy over the last 10 or 15 years that would cause that to probably be different? A couple things.
So can I make the assumption people are wealthy from the 95 cars?
No, that's not one of the reasons. Something. Oh,
Like that Ashford Bunkers thing, I think.
no.
The dealers started selling directly to the parts.
What did you say? Lease? Leasing cars. There's number one. There's the key reason. How long do people lease cars for? Normally.
36 months.
Exactly. 36 months, 3 years. How long are warranties?
5.
Up to 5 years, right? So you got a lease car with a warranty, right? Do you take it to your local garage first to get it fixed? You take it back to the dealer, right? You go to the dealer, right? Garage's business went down. Okay. Another thing, cars are more technologically built today. They're not built the way they used to be with the mechanic under the hood. You got to be specialized. You got to put them on a computer. Garages aren't necessarily all tuned to be doing that. And who wants to take their very, I don't know if that car can be touched by somebody other than,
The dealer.
the dealer. Hey, listen, last summer I got a new Audi, which I leased. And within 1,800 miles, smacked it into the back of a truck and ran up 20 grand in damage, okay? I didn't hit the truck hard enough that he even knew it. It wasn't a truck, it was a Suburban with a trailer hitch on the back. My aluminum framed Audi and that steel trailer hitch, steel trailer hitch 1, Audi lost. I went underneath and it took the front back. I tried to get the car fixed by a local guy who fixes my cars. Eventually, he had to take care of the Audi. There's a turbocharger and resets, and he went, I don't know how to do any of this stuff, okay? So that, you're exactly right. Leasing, but this guy had a business. That along with, we didn't get, the other thing to determine, want to know when companies like that do well? They just did well. Companies in that business. You want to know how you understand the business? Climate. Climate was key to his business. He used to tell me the greatest thing in the summertime for his business was driving down the shore in the summer on a Friday afternoon with 100 degrees and seeing people pull over to the side of the road over here. That was good for his business. You don't think car repair places did well in February? When the ice and the snow and you saw the accidents? I hate to say this, they're cheering it on. They need bad weather. You want to be in the roof business? You pray for hurricanes. Let me ask you a question. You think people didn't get rich off of Sandy? Oh my Lord. Construction people were dying. Sandy hit. They didn't want to say it out loud, but they were going, yeah. My business just went through the roof. Literally, Every business has that, okay? So yeah, they used to tell me the greatest thing our business thrives with dramatic climate changes. We like very cold, I've got a guy, friend of mine, in the heating and air conditioning business. He prays for extreme weather. He needs extremes. The worst thing that can happen is 70 degrees. You don't have the heat on, you don't have the air conditioning on. It was 0. Oh my God, the cash registers was clinking, my heat doesn't work. Oh, sorry, yeah. That wasn't repaired, but that's the truth. And then in the summer, it's 100 degrees, everybody's air conditioning. Says they're screaming at you. You got to be over here in 5 minutes. And I don't have that many people. But yeah, that's how business works. So economic conditions, absolutely key determinant in understanding a client's business. And then, of course, the attractiveness of the industry, barriers to entry, strength of competitors, your bargaining for raw materials, understanding the client. It comes back to the same thing all the time. Understanding the client and how the business works. How does it thrive? This is all part of it. Operating objectives, overall plans. Understand your client's plans. Are they trying to grow real quickly? Are they happy the way they are? Are they looking to go public? Looking to save taxes? All things enter your mind when you talk to your client. You're talking to them and go, what's your game plan here? Oh, I'm looking to borrow money this year. Yeah, hoping my financial statements are real strong. I got to go to the bank. Well, do I have a little higher risk now that there's going to be some type of misstatement? Absolutely. What do you have? The business risks. You got to look at business risks. Threats to achieving, because when there's business risks and clients can't achieve their objectives, that's when your risk, your audit risk goes up, because there are going to be other ways that they achieve their objectives. That they want the stock price to stay high. Well, if I can't do it through successful business, am I going to get a manipulation in numbers? Better known as things like Enron and WorldCom. That's what those are all about. Why did WorldCom put things on the balance sheet that should have gone on the P&L as expense? Well, they got to show the stockholders are doing well. Couldn't do it through business. Well, what you can't do selling, maybe you can do with pencils, so to speak. So that increases your risk and it changes your audit strategy, okay? You'll look at, again, going over and over more things. You'll look at their budgets, key performance indicators, variance analysis, all stuff, segment performance reports, you don't have to manage, balance scorecards, external parties. So once you've got a real good understanding of the client, what's in the client's head? What are the client's goals? What is the client's business? What drives this business? What makes this business tick? Once you understand what makes the business tick, then you sort of have an idea where the risks are and understand what could go right and what could go wrong. And you know where to attack. You can't really do that just picking up a balance sheet and looking. Like in that case with the receivables. I pick up the balance sheet, I see $1 billion in receivables. Does that mean I have risk because it's a giant number? Well, I don't think in this case I did, because it's all a lot of small stuff. It's like counting inventory. I used to do this all the time when we valued inventories. And I would make assessments of how much risk. So what's the inventory made of? Is it made up of a zillion small things? 3 of these, 4 of these, 10 of these, 20 of those? Then my risk isn't real high. My risk becomes when I have a lot of something. Do I have an obsolescence issue? Do I have too much of something? Do I have a problem with a sell? Okay? Do I have something that there's a lot of technology to that's going to change? But when I have $1 million $10 items, and I don't have any major items, I go, I don't see where my big risk is in this inventory. Yeah, I'm going to check the math, make sure it adds at the bottom, okay? Because they didn't add $1, come up with $20 to do it that way. But in auditing any particular item, I don't find there was a lot of risk in anything. As opposed to when you get inventories with large items that have something to them that can be tricky. So again, it's knowledge of your client. Before you do anything, though, you got to assess the internal controls, okay? What controls exist, who performs them, how transactions are processed and recorded, and what the accounting records and supporting documents exist. Now, companies' internal controls can really vary. Some have really good controls. I remember scared to death the first time I walked in. There's a company that doesn't exist anymore. It was called Top Supply in City. It was an electronics retailer, electronics and appliance retailer that originally started down in Edison, New Jersey. Started by a guy who was one of the best marketing people I ever saw. First day we got the audit, we walked into the back offices, and on the tables, literally, were piles of cash and piles of NSF checks. But they hadn't had a chance to actually go back and get the checks. Go back to the customer and say your check bounced. They were just so intent on selling. Cash was lying around, NSF checks were lying around. Talk about internal control problems. I mean, it scared the heck out of you to see stuff like that. You didn't know what you were going to be auditing. So you're going to go through and you're going to make assessments on internal control. You're not going to do it in a vacuum. You're going to do it with internal control forms. Most every firm has got them. They're easy. You're going to go down them. You're going to ask a series of questions based upon what the client's business is. And then you're going to do a series of tests to see whether the controls work. Because off of that, it's going to be what you're going to determine what your other audit procedures may be. When we audit something like this, you say, how do you audit $1 billion in accounts receivable made up of a bunch of $20 items, okay? You're testing controls. You're taking transactions, working them through the system, seeing that they're recorded properly, that the invoices are going out, the invoices are proper, that the bills are being, that they're eventually getting paid properly, that the right people are entering things, that there's no ability for people to, who has the ability to work with the accounts? I mean, is it, can people get into other people's accounts? Can people make adjustments? You're going to walk through this, and off of that, you're going to get some reliance or no reliance on how good the controls are in terms of how much auditing, substantive auditing, you have to do later. So again, and this is where, again, as we said, we get repetitive a little bit. How do you get your information? Well, you ask questions. How do you learn about the business, industry, accounting, and auditing, guys? That's one of the ways. That's one of the good things in our business. There's so much literature out there. Okay. Specifically, when you're in a business that's different than other businesses. You're auditing a bank. So what do you compare it to? How do you figure out? You've been auditing manufacturing and distribution companies. All of a sudden somebody says, okay, now you're working on a bank. Well, that's completely different. How do I know where are their problems? What should I be looking at? Well, the AICPA over the years has issued what we call accounting and auditing guides that help you with particular industries and tell you where to look and what the right auditing steps are in these particular industries. Industry risk alerts are sent out. What happens when an industry all of a sudden has a problem? When real estate a few years ago went in the tank, well, they send out industry risk alerts. Hey, this industry's got issues now, guys. You're out there auditing. Here's the issues. Here's the things you should be looking for. Be careful in that industry today. It's got problems. So there's things to help you along the way here. Of course, anything you read is always helpful as long as you stay informed. Government publications, anything. Obviously, reading prior annual reports, SEC filings. You get put on a job. One of the first things, if you're working for me, is you say, okay, Michael, I'm working on your audit. What do you want me to do? I tell you two things. One, go read last year's financial statements. Give you an idea of what the company does. Where are the major items? What are the big items? What are the things that look material? And read the work papers. Did we make a lot of adjustments? What's in the work papers last year? That'll give you an idea about the company and what to expect. Remember, it's based upon expectations. Once you've audited a company, you have a fairly good idea what you're looking for, where to look. We always look at prior tax returns. That always gives you a little bit of knowledge. Always a key. Tour the plant and the offices. There's a lot of good things to be gained walking around somebody's offices. You learn a lot about a company if you're keeping your eyes open and you're asking questions. You walk in the warehouse, and they're walking around the warehouse, and he says, we talk about the inventory, and you walk down a couple aisles, and you look at the boxes, and they're all dusty. You see piles of dust on a bunch of boxes. Rent should go up. What if I have obsolescence issues? Those boxes have been sitting there a long time. Okay? What's that pile of stuff in the corner? Oh, that stuff we're not selling anymore. You take note of that. Maybe that's in their inventory. It shouldn't be valued. You walk around the offices. How many people are here? Who's doing what? How long have your people been here? Oh, you've been here 10 years. Good, you have a pretty good idea. Well, I've been here 2 months. I've been here 1 month. The controller's been here 3 months. Uh-oh. How much do they know? Why is there so much turnover? Even looking at the way they keep their offices is a sign to you of something. Are they neat? Are they messy? So there's a lot to be gained. You walk around, you ask questions. You can learn a lot about a company just walking through the building. And of course, we come back to always analytical procedures. Looking at the numbers, seeing what makes sense. Looking at the cash flow statement. Really important to understand a company is the cash flow. Remember, cash is the lifeblood of a company. You learn this term in financial accounting, materiality. It's really a professional judgment. Okay? There's some numbers that are out there that people use, 1%, 2%, 5%. But a lot of it is purely judgment on what's material. Materiality, again, can be both what they say qualitative and quantitative. They may have broken a law which is not really quantitative, but in qualitative it can be significantly important to the business. So when you're looking at making materiality judgments on whether something's material or not, you're going to look at dollars and you're going to look at the qualitative aspect of what the item is, okay? And it's based again on a reasonable person. Always as part of the audit planning, you're going to make calculations on what's material and what's not. There's always in the plan something, you make calculations based on balance sheet, particular account sizes, and income statement. What is material if you find an adjustment? In a company like this, we might find a $500,000 adjustment in receivables. I say that's immaterial. It's just not big enough, okay? We find, give you an example, we find an item here in our desk. This is a company with an extremely low margin. Extremely low gross margin, okay? So we find that they made $1 million sale on December 31st. They were recorded on December 31st. $1 million they sell to a customer, December 31st. We do a cutoff test and we find out you booked it on December 31st. So on December 31st, what did they book? They booked an entry like this. Debit AR 1 million, credit sales 1 million. Debit cost of sales, they only made 5%, so they credited cost, debit cost of sales for $950. They credited inventory for $950. Okay? So they made $50,000 of profit on this item. Say you booked it in the wrong month. Should be booked in January, not December. This is immaterial. Current assets are okay except for 50 grand. P&L is off $50,000. This is a company with $5 billion in assets, $5 billion in revenue, and maybe $100 million in income. Yeah, $1 million sounds like a lot of money. They booked it in the wrong period. It's not material. You don't care. Yeah, it's wrong. Doesn't make a difference. It's immaterial. So we determine in the planning stage materiality as it relates to the overall financial statement, as it relates to the income statement, the balance sheet, what would be big, what matters, and then we look at it as it relates to individual accounts too. There's definitions here of what materiality is. I'm not really different definition, but mostly it's in the eye of the reader. If something's materially misstated, it basically says by being misstated, you're going to form a different opinion on something, okay? If this company shows a profit of $80 million or $81 million, you're not going to have a different opinion on this company. It's not going to cause you to do something one way or the other. So $1 million in this case is not material. Or at least probably is not in that case. Whereas a company that's on a break even and you find a $100,000 error is material. The difference between breaking even and losing $100,000 is much more material to the reader reading the financial statement than the difference between making $81 million and $80 million. Okay? One case it's $1 million and you go, who cares? The other case it's $100,000 and you say that makes a big difference. So again, what's the whole approach of risk? What could go wrong? How likely is it that it can go wrong? And what are the likely amounts that involve? So again, looking at my receivable. What could go wrong? Yeah, I can have some receivables that aren't right. How likely is it that it will go wrong? You can define it. It's one of those things as an auditor, you only sort of know it when you see it, okay? Yes, we do put it in terms of numbers because we have to. Because as we're doing the audit, how do we know at what point in time? So you find a mistake for $500,000 and you say, well, that's not material. And then you find another $500,000 and go, well, that's not material. But when you add them together, they become material, such that they're all going in the same direction. You find $500,000 reduces income, this one reduces income. You go, well, neither one was material, but when you put them all down on the same piece of paper, they're material. To some degree, materiality is something you know it when you see it, okay? And you get it through experience. Now, but again, you can't really define it that way in an audit. You actually have to put numbers to paper, okay? But asking you to memorize a definition, that's not really your style. And then what are the likely amounts involved? So in this case, we can look at this and go, what could go wrong here? We can have some bad receivable. How likely is it will go wrong? Maybe there's a likelihood that some of those receivables are right. What are the likely amounts involved? We say they're minimal. We don't think they can be big. We come back again to the inherent risks in the type of an account. We say in an account like that, we don't think there's a lot of inherent risk due to the size of them. And the risk of a material misstatement due to fraud. Well, if you look at this, you have to have a lot of fraud in an account like this to really have something material, okay? Somebody could steal $1 million out of that and it wouldn't be material. Now, the client may find that to be material. But if you had $1 billion in receivables and you owe $1 million, nobody would sue you over that. It's not a material misstatement. When you find these things, what do? You just do more auditing. It's really that simple. It's logical. Hey, I'm not finding things here too good. Let me keep looking. I mean, fraud. What are our responsibilities? Are our responsibilities to find every little fraud? Absolutely not. Absolutely not. The clients think that. Well, sometimes they do, sometimes they don't. There's two types of fraud. Fraudulent financial reporting, which is what we're talking about here. And of course, misappropriation of assets, defalcations, people stealing money. I've seen both, okay? Who does them? Well, it changes. I mean, anybody, I guess, is fraudulent financial reporting is either going to be top management or the accounting people. Misappropriation of assets, stealing something could be anybody. I mean, I've seen it. I've seen it. The secretary in the office, who was responsible for keeping the checkbook, stealing money. I saw an incident in that a few years ago. So misappropriation, defalcations, you have two types of frauds. Okay. You have a responsibility. I don't think nobody used to be SAS 99. You have to go out at the beginning of every audit and interview people in the company about fraud. Standard questionnaire. It's not you go out and just ask questions willy-nilly. You're going to go out and you're going to have inquiries of management and other personnel. You, the auditor, pick the people. You normally alternate every year who you're going to talk to other than certain people. You're going to talk to the owners of the business. You're going to talk to the CEO, the controller, the key financial people. But you're going to talk to other people. You're going to go talk to somebody in accounts receivable and find out what they do and what other people do related to receivables. You're going to talk to somebody in accounts payable. You're going to go out to the loading dock and talk to somebody out there. You say, why am I talking to somebody on the loading dock? Well, what is the internal controls in this company to make sure products are coming in, are accounted for, and products are going out, are accounted for properly? We have locks on things. You're going to ask questions like that. Because once you find these loopholes in their system, that's when you've got to increase your auditing, because then you've got a possibility of a fraud. This stuff happens. Of course, you're going to assess it around the risks of a particular company of what they do, okay? There's companies I don't worry about them stealing things, okay? There's companies you do worry about it more, okay? And what they're going to steal. Obviously, in retail, you're going to ask more questions about things than maybe somebody, again, who's making cement or something like that. There's companies I've audited and go, I don't really worry about, your employees stealing your product. It's just not a thing you can steal too easily. Other companies, yeah. I worked in a company that worked around precious metals. And when we went out at the end of each night, we went through a metal detector. You were not allowed to leave that company. They used to take metals, refine them, and then make other things with it. And a lot of what they got when they were refining metals used to be precious metals. There was gold and silver in there. So you and any employee left the building if they went through a metal detector. That was part of the deal. Even in the accounts, we don't do that, okay? So you do procedures to assess the fraud. You do inquiries of management, and you consider what other incentives, opportunities, attitudes you get when you talk to people and you look. I mean, you use your common sense like you do anything in auditing, okay? In a bank, I mean, they have a lot of controls over fraud, and still think people do stuff. Again, but you're worried again. You want to design your audit around it, but again, what are you looking for? The type, the significance? If you're worried, you're not worried about the secretary taking $50 out of the petty cash box, okay? That's not the problem. You're worried about material things. Likelihood that you'll have a material misstatement or a material fraud. We are responsible for material frauds, but somebody walked out with the petty cash box, they can't blame the accountant for that, okay? And of course, the pervasiveness of it is a real weakness in the system. What do you do when you find a fraud risk? Well, again, your response, of course, you're always, professional skepticism again is one of the keys. It's that attitude of, like I said, it's not being spy, it's not being confrontational, but you've always got your ears and eyes open. You're not just ticking and time, okay? If you've got a problem or you sense there's something with a client, first thing you got to look at is who your audit team is that you're sending out. When we assign an audit team, or any firm assigns an audit team, the experience level and the personal background of the auditors is key in assignment. One, you want to assign auditors who know the industry, and B, based on the level of what you're looking at, the complexity of the company, you assign a level of auditor that sort of complements that. So if I've got a company where I think there's fraud risks, where I've got and again, it's not just stealing. If I've got a company, I'm a little risky on them, geez, they're not doing real well, chance of a misrepresentation could be a little higher, I'm going to assign a different level of auditor to them. I'm not going to assign a bunch of new staff to them. So, again, and then making sure I supervise them properly. And everything I'm saying, you should be saying, it's all common sense. And it really is. It's all just logical to me, okay? The last one's a very interesting one. You might not know why, but I'm going to tell you why. Predictability of auditing procedures. Anybody want to comment on this? What they think that means? I'll take it. What does that mean?
You know what they're gonna audit and they can give you what you are looking for.
Yes. Steph. Increase sample size, shifting timing. The closer you get to the year, the better you're doing. A lot of companies want, there's continual auditing, you're doing procedures during the year. If you feel there's a problem, you want to be closer to the end of the year if you can, okay? And you always got to be ready for the possibility of management override. I won't go into that story. Okay? So here's another thing, always, absolute procedure. We require it in all cases now. You need to do a journal entry examination as part of your audit. You've got to look at adjustments. The biggest thing that went wrong with WorldCom was simple, journal entries. If they had done a better journal entry examination, WorldCom may not have happened. There were journal entries. Debit assets, credit expense for billings. Simple journal entries. You got to do a journal entry examination because when all else fails, we'll just make an adjustment. If you're going to get management overrides or fraud, sometimes it's not through creating sales invoices. It's simple journal entries. You're hoping the auditors don't look at the entries. So again, you're going to keep fraud in your mind throughout the audit. If you discover it, your responsibility is communicated to the next level of management. So if you catch the controller, you talk to the CFO. If fraud involves senior management, you got to go right to the top. You may, if it's the owner of the business itself, you may have to resign the account if you can't do anything about it. If you've got a private company, sort of like that, what would we do? I think we would have had to resign. In a public company, you got to go to the audit committee. That's your requirement, okay? Design for after you test controls, you're going to design the rest of your audit procedures. And what are our audit procedures? Again, we come back to the same 6 things that are our standard audit procedures. It varies by type of account: inspection, observation, inquiries, confirmations. We're going to talk much more about this later on, especially when we get specific accounts. Recalculations, like in depreciation, reperformance of certain procedures to see that things come out. So those are your standard audit procedures, and we're going to see how they apply to varying accounts as we go along. Again, substantive procedures. This is not just the internal. We've got our substantive. We've got our analytical procedures. We've got our internal control tests, and then we're going to do what's called substantive procedures for all relevant assertions. In other words, the things that are important, the things that we determine need the auditing in effect, is where we're going to do these substantive procedures, where we're going to either be examining invoices, counting things, valuations, etc., etc. And we keep talking about this, and again, it's all logical. Procedures should be linked with risks, assess risks of material misstatement. This is the same sentence we've talked about over and over again, okay? We're looking at where we have risks, where we think things can go wrong, where we can have a material misstatement, and we're gearing our procedures exactly to those assertions. So it's all logical, okay? You come up with assess risk of material misstatement being high. You got a financial statement you're worried about. What are you going to do? The logical things: heightened professional skepticism, signing more experienced staff. You got a tough audit. You don't send out a bunch of brand new accountants. Okay, that seems to be a case in some instances. That's certainly an area that the lawyers attack. You get a bad audit. What do they look at? Who worked on the accounts? What level were they? What experience? What supervision was given? How much review of what they did? Did you send out in a quote in effect a bunch of juniors to audit a very high-risk revenue recognition account where the people are obviously inexperienced, specialized skills, and more? It's almost, like I said, this is just apple pie in America here, okay? You got something you're more worried about, you sign more experienced people. I mean, how much more can it be than that? Audit documentation. We talked about this: procedures, results, consideration of fraud. All this has got to be written up in the papers. This is the normal area that when the peer reviewers, the PCAOB, come in, they attack. Did you document what you did? Did you consider fraud? Did you document it? Okay? The procedure results. You did procedures. Did you document the results? Why you did them, what it proved. Did you document your risk assessment? All important things that have to be in your work papers. We talk about audit trails. And I'm going to read over this every time I'm reading a book here. I never thought about it this way. And it is an interesting way to sort of look at this. That in order to follow an audit trail in either of 2 directions: test for existence or occurrence, or test for completeness, okay? So if you read the book, we'll talk about existence or occurrence first. This is where you're looking to find unsupported financial statement amounts, okay? This is where the type of test involves tracking back amounts recorded in the financial statements. So we're looking for here, we start with the financial statement amount. We take the amounts that are effectively in it, okay, and we audit what we see. So if we saw receivables with $1 billion, okay, we're going to take these numbers and audit back from them. So we're going to look at what's in the books and records, what's in the receivable accounts, okay, and audit that way. Now, if something's not there, you're not going to be able to find it, okay? So if something was left out, and $1 billion should have been $1.5 billion, by auditing these numbers, this direction, from the financial statement backwards, you will audit the effectiveness, the validity of that. But if something's not there, you'll never find it. Okay, you can't find it that way. When you audit the other way, what you do is you take the transactions, you go into the sales journals, you pull all kinds of sales invoices out, and you track them through the receivable system. So that if something's not recorded, you would find it that way. So it's either way of tracking, from the documents on up or from the financial statements on down. What do? We do both. You're going to do a little testing of each. You would take part of your sampling process would probably be to pull a bunch of sales invoices during the year and go through the sales process and make sure it works its way through the sales process. And that's what they talk in here about transaction cycles, and we'll talk about that in a second. Or you audit the receivable account, and you're going to do that. Say, okay, what's in that $1 billion? Let's make sure those are all valid, that those aren't fake. So we're going to find the documentation that way. So there's two ways of doing this, and in a lot of cases you do both. So again, it's a direction of audit testing. And you're looking for either overstatements or understatements, okay? If you were starting with the transactions on up, you're looking for understatements. Transactions that occurred, you don't find in the books. If you go that way, you're looking for things on there that didn't really happen. So that's more of an overstatement way of doing it. When you do transaction testing, what you normally do is call around transaction cycles. You take parts of the business and you walk through those parts of the business, like the revenue cycle. You're going to go from the selling, you're going through the whole selling process. So you're going to be testing receivables and income recognition there. You're going to pull invoices in effect, trace them through the system. Did they get recorded properly? Did we collect the cash? Has receivables been recorded properly? Have sales been recorded? Acquisition cycle is really purchasing. Conversions, manufacturing. You're going to walk through the payroll cycle. Is everybody there? Is payroll being done right? Investing, financing, different parts of the business. So you're not taking it from a balance sheet standpoint necessarily. You're taking it more from an operational standpoint. So again, transactions affecting receivables. If you were checking that, you would be taking a transaction to these transactions and testing the system to see that it works. So here you say, well, what transactions affect receivables? Of course, sales, cash receipts, sales returns and allowances, uncollectible write-offs. All tests that you're going to do in the sales cycle. So again, you're going to all deal with audit programs. That's a must. I didn't grow up with audit programs particularly. We should have devised our own. We didn't have standardized audit programs. Today, every company, every accounting firm is going to have standardized audit programs that are quote-unquote tailored to each client. So you have a standard set of receivable programs, and what you're required to do is to take those programs and say, okay, here's the steps that apply to my client. These steps don't apply. My client doesn't have this type of a business, but they do have this that's not in the standard program, and you tailor it. And once you set up a tailored program, you can use it pretty much year to year. You're going to, So all these systems testing and internal controls, the substantive part of the audit, are all going to be governed by your audit programs. The audit programs are required parts of your work papers. They've got to be signed off on. They've got to be initialed. They've been reviewed. And you've got to complete the whole thing. You can't just do parts of it. In other words, you're going to have a standardized program and you're going to follow it in terms of auditing whatever accounts that you're assigned to. And you're going to deal, like I said, with indirect and direct verification of income accounts when you get to this. What does this mean, indirect and direct verification of income accounts? When you audit, most audits, the way I was taught, and we still do this, mainly gear themselves towards the balance sheet. They start with more of a balance sheet emphasis. Because if you think of the concept, if you get your assets right, if you get your liabilities, if you've got the right assets, you have the right liabilities, well, you have to have the right equity, okay? And if you have the right equity and you started with the right balance, then effectively you have the right income, okay? It sort of falls in line, correct? Assets are right. I got all the assets. I got all the liabilities. Well, the formula's got to be right. Equity's got to be right. If I know what my capital stock accounts are, That leaves retained earnings. That's the balancing number. It's got to be X. What started at X, or it started at Y, it's at X now. What's the difference between the two? I know what my dividends were, so I know what my bottom line is. So we hear most of our auditing starting point from the balance sheet. But when you do a balance sheet examination, you pull in a lot of the income statement. When you audit fixed assets, you effectively audit depreciation, okay? Part of it. When you audit receivables, you tie in revenues, okay? When you audit loans at the bank, you tie in interest expense. When you audit investments on the books, you tie in interest income and dividend income. So you're pulling a lot of the income, and that's what it means by indirect verification of income statement accounts. Automatically, by auditing the investment account, you're going to pull in your audit of the income, of the interest and dividend income accounts. You don't have to do set up a separate program to audit dividends. If you audit investments, when you look at the investments, it's going to show you what the dividends and all are. So we sort of try and put those things together to capture as many accounts as you can at one time. You're not going to do depreciation audits separately from your fixed asset. Okay? It's all part of one. So you're going to pull in some of your income statement. You audit your prepaid expenses. Well, your biggest prepaid expense may be insurance. Okay? So you're going to examine the insurance accounts as part of your prepaid expense account audit. So this just shows you a little bit without me going through it, that you get into verification of income statement accounts as part of your examination of the balance sheet. We're going to keep talking about these all semester objectives of substantive. We're talking about asset accounts now, okay? The 6 things that we're looking for in asset accounts, okay? When we do an asset account, what? What are we trying to establish? First, the existence of the asset, okay? That it actually exists. So we take something, let's take something like inventory. How do we establish existence of inventory? By what? Excuse me? Exactly. We can't go look at it. We know it exists. There it is. I saw it. It's right there. Okay. You laughed at it. Is that obvious? Well, yeah. You think about doing all the record keeping and doing all the other tests, but you never actually saw it because the guy sold it when you weren't looking. Okay. So yeah, verification. We're talking about inventory as an example. Existence. Yeah, there it is. Establish the company has the rights to it. Here's one that's not so easy. A lot of businesses, one in particular that I've dealt with, again, I bring it up a lot of times, is the jewelry business, deals a lot in consignment goods. They deal a lot in consignment goods. So we sort of say, listen, I don't have the money to finance putting your stuff in my store. Okay? You want to sell goods, you need me to sell them, I don't have the money to stock them. But here's what we'll do. I'll take them on consignment. I'll put them on my shelf. They're yours still. If I sell them, I'll pay for them. Okay? I'll give you the cost. I make the profit. They're yours still. They're not mine. You can come in and check every once in a while. Make sure you sell them. Okay? And if you're in the jewelry wholesale business, you may say, hey, listen, I don't like that. But I can't sell it unless it's on this shelf and you open it. So take that asset. Establish the existence here. I saw it. It's right there. Establish the company has rights to the asset. No, it doesn't. Okay? So you have to establish now that you actually own it. Okay? You saw it, you own it. The completeness of recorded assets. Do I have the whole inventory? Or did they stick some in another warehouse somewhere because they don't want to pay taxes? Verify the cutoff of transactions, okay? Did they record things in the right period? Did they sell things on January 1 and recorded them on December 31st? So we got to make sure that the cutoff was done properly. Determine the appropriate valuation of the assets and the accuracy of the related transaction. Valuation. I counted the inventory. I know it's mine. The cutoff was right. Is it valued properly? Well, geez, I have 1,000 of this item. I've had an inventory for 3 years and I sell 100 of them a year. Do I have an obsolescence problem? Maybe. I have a video game, I sell video games, and well, how often do they change? I don't even know if you can buy video games anymore, except you can online. You can? But they go out, but if I have last year's games, if I have the NFL 2013, well, that probably doesn't have a lot of value, right? So,
The value is like $30 maybe between year to the other year.
yeah, there's a difference.
Yeah.
They go down in value. What if I have too many of them? I passed all the other tests, but I didn't price the valuation test, so I wrote it down. And then, of course, the financial statement disclosure. So we've got to go through that for every asset, some more so than others. Controls in receivables and sales. What are some of the examples? That we're making sure that all goods shipped are accurately billed in the proper period. Let's look at internal controls in an accounting firm. We want to make sure, what do we want to control? First thing is we want to control the input into our working process. How do we do that? So we put in systems to make sure our employees enter their time daily. If we don't have a way of controlling that and checking that, if our employees don't enter their time, okay, we don't have a way of billing it because we don't know it exists, okay? Then we have to have a system to make sure that our partners, now that we're corralling the time, are billing our clients and are billing them properly. That was one of my jobs when I was running the office, was to examine the work in process accounts and to scan and look at the bills as they went out, okay? They would say, do you really have to do that? Well, the fact is, yeah, we did have to do that. To make sure that my partners were billing properly, either not too much or not too little, okay? Were they billing in accordance with engagement letters? So there was a lot that you could say in terms of AR and controlling it in the accounting. So if you looked into a manufacturing or a distribution company, are all the invoices being recorded? Are all the shipments going out, okay? Is there a control so that things can't get shipped out without there being invoices issued? Can people be shipping out merchandise unauthorized and collecting the money themselves? So those are all things around internal controls that are important to a business that you as an accountant have to look at in terms of determining the accuracy of the records you're going to be looking at. Because if those controls don't exist, they're going to make the possibility of a material misstatement greater, and thus you have to increase your audit. Okay? Again, what is the purpose? Safeguarding assets. Okay? I mean, really, safeguarding assets is key. We want to make sure we keep our stuff, whether it be inventory, cash, or receivables. You look at companies or businesses that have great internal control, and you see. If you looked at a casino, and again, I've told you the story, I spent 10 years of my life, not 10 years, but for 10 years, I spent 2 to 3 months a year in Las Vegas auditing casinos. And they're controlled. I mean, there's chips and money flying everywhere in the casino. I mean, you think of the millions and millions of dollars they're going through there. And I'm telling you, stealing in there is virtually impossible. Their controls are so tight on the counts and the chips and the people watching you. I don't know that you could steal a chip without somebody catching you. Seriously. Stealing $5 would be difficult in there. Anyway, back in 1997, there was something passed called the Foreign Corrupt Practices Act. The purpose at the time was to stop illegal payment of bribes to foreign officials. But included in the act was something that requires an effective system of internal control. And it sort of put in this rule on internal controls of corporations. There's 3 levels of internal controls that we got to talk about, and then maybe we'll call a halt just after I get this. They're called preventative, detective, and corrective internal controls. Preventative, corrective, detective and corrective internal controls. The first is preventative. Those are ones that aimed at stopping something before it happens. Okay? So we put in controls, and the easiest example, the one that we push the most as accountants to our clients, is what's called segregation of duties. It is the first spot that you find weaknesses in that employees take advantage of when you haven't segregated duties. At my client that had that fraud that I did tell you about, where the controller stole the money, I was going to the racetrack. Remember I told that story? I think I told that story in here. I forget where I told stories. Did I tell that story? Next time. I don't want to make Steph come up and turn it off. In this case, the controller controlled the checkbook, the general ledger, the bank reconciliations, the accounts receivable reconciliations, and cash collections every day. Segregation of duties? None. So you have control over all that, okay? Anytime you give an employee too many responsibilities where they have control over, not only, the way you segregate it is control over the asset and control over the accounting for the asset, okay? You have both controls. This is one catch this. We do bank reconciliations for this purpose, okay? If somebody steals a check, maybe we're going to catch it when we have a control in to do bank reconciliations to protect them. In the case of that client that I'll tell you the story about some other time, there was no segregation of duties and he did the bank recs. So there was a control, but he did them. So where's the control, okay? And then finally, corrective ones. What if something goes wrong, we lose something at all, and we have all the backups? Backups are corrective. We can fix things with backup. So we got three types: preventative, detective, and corrective controls. And they're used in various aspects of the business. You need some of each, okay?